Welcome back. We're continuing our coverage of the Reserve Bank of India monetary policy, and with us are a bunch of experts to help us decode that policy. Pranjul, Bhandari, Chief Economist at HSBC, Ashhish, Vaidya, Head of Treasury and Markets at DBS Bank, Jairam, Sridharan, the Managing Director at Piramal Capital and Housing Finance, Soumya, Kanti, Ghosh, Chief Economist at State Bank of India, and Neeraj, Gambhir, the Head of Treasury and Wholesale Banking at Axis. Pranjul, gentlemen, thank you very much for your time here. Mr. Soumya, Kanti, Ghosh, I'll start with you because that 7% GDP number, you were one of the few to have a similar number in mind before the RBI announced it. But, now the Deputy Governor, Michael Patra, indicating that even that 7% may be a conservative estimate. What do you make of it?
Yeah, thank you, Ritu. I think in our last note also, we have said the same thing, that 7%, there is an upside bias to the 7%. So it could go anywhere higher than that. I think at least 20 basis points given the current rate of growth. So, and that's a fair assumption. And I think we have been maintaining all along that growth would be a positive surprise this time. The only issue till now is I think the inflation numbers for November, December may look a little bit wifey in terms of more than 6% number. But overall, I think the policy is in the right direction, right communication, right steps, and this ends the year 2023 on a positive note.
Well, Pranjul, what were your key takeaways? Anything in the fine print, that we haven't addressed so far?
Yeah, so look, I would agree with Soumya, Kanti, Ghosh that GDP growth looks good, but it actually has two parts to it. We saw this big number of 7.6% in the September quarter. There were a lot of statistical reasons too why it was so high because of the the CSO doing single deflation instead of double deflation. My sense is that the statistical reasons led to 100 bips more growth. If you take that off, then the actual growth on the ground was about 6.6%, which is also very strong growth. And I do think that is something that will continue over the next couple of quarters. And I think one thing that has changed, I think, is rural. And the governor really focused on that in the press conference as well. Rural was a laggard till a few months ago, till a few quarters ago. But now with prices of food being higher than MSP, with a lot of inflows from urban to rural India, construction sector doing very well, where a lot of rural Indians work, rural is actually turning the corner. And we also see generally informal sector doing much better than before, given that they've come out of the pandemic world and commodity prices have fallen. So generally, I think now the growth we are seeing is more broad-based, and that's why I think it's a little more sustainable. So, I don't have too much of a grudge with the 7% number that the RBI has. But the area where I have a little bit of a problem is how can you be so fast growing but not see inflation? How can you not change inflation numbers but really ramp up your growth numbers? And I think that's something we'll have to focus back on in the next couple of quarters.
Well, Mr. Neeraj, Gambhir, what do you make of this? Because, inflation, like Pranjul was saying, has been left unchanged. For the FY25 numbers that they've given, they see it going down all the way to 4% as well. What's your sense on this front? Should it have been revised in line with this larger projection as far as the growth numbers are concerned, much to the surprise of the markets, it seems?
So, first of all, thanks, Ritu. First of all, it is a policy which was maintaining the expected level of hawkishness as far as the governor's statement and positioning is concerned. Although we didn't have anything new in terms of new set of measures, but the fact that there is very clear focus on inflation management and the fact that inflation is yet above the target level of 4% and not expected to get there until FY25 end is something which is likely to keep the monetary policy on hold for a fairly long period of time, unless until we have some shocks. Now, to come back to your question, I don't see any reason for a revision in the inflation forecast as yet, because if you notice that the core inflation is very well behaved, although it's at about 4.5 to slightly around 4.5%, but it is fairly stable. And if you look at the inflation services sector, the core inflation services sector, it is actually now currently running at about 3% for several months. So there is a reason to believe that the core is well behaved, the core is well anchored. There will be ups and downs as there are some shocks with regard to food prices. There are some variables that may kick in. But net, as long as the core is well anchored, the expectation that inflation will steadily go towards 4% over a period of time, I think it's a reasonable expectation.
Okay, and Mr. Ashhish, Vaidya, if you'd weigh in as well. Even that threat of OMO bond sales, that seems to be, at least for now, off the table. The governor said there was no need, for us to use it so far. What's your sense now, even with this easing for liquidity management, opening up the SDF and MSF windows over the weekends, how do you see this and where do you see the 10-year trading in the near term?
So the liquidity measures or so-called the weekend windows which the governor has opened was very welcome, and it was actually a market ask for some time. So I think that's on the expected lines. To my mind, actually doesn't change much of the liquidity management. It only soothes the volatility. So it makes it a little bit more manageable, which has been said in your channel earlier. I think as far as the benchmark rates are concerned, given the guidance which we have seen in this policy as well as the earlier ones, I think we are pretty much at the top end of the cycle, which is very evident from what we are seeing across the world. Most central banks are actually have been hiking rates for quite a while, and the economic activity is sort of sobering down. And I would think that somewhere around this range of 5 basis point up and down should be the range for the near term, eventually heading lower. And my sense would be that probably in the first half, we should start to see some global moderation in terms of recessionary fears actually setting in the developed markets, which eventually will start to impact the emerging markets as well. And that's the time we really need to take a call as to how exactly the markets will pan out.
Okay, Jairam, two questions to you. One, of course, lending rates, of course, remain unchanged. What happens to your cost of borrowing? How does life change? And secondly, on this connected person rule, how did you read it? I mean, where is the lack of uniformity that RBI seeks to bring in with these new rules when it comes to persons who could influence the credit-making decisions at, financial institutions? What are you expecting there?
Thanks, Ritu, for having me. On the first point on rates, the rate situation is not influenced at all by what happened today. Not much has changed in the debt markets as well, as we can see. There is a lot that has happened, though, in the last few weeks, ever since RBI's previous circular on risk weights, etc. And that is what will flow through for the next little while. So clearly, unsecured lending to consumers will continue to get costlier. Lending to NBFCs, particularly the smaller or kind of lower-rated NBFCs, things are going to get a little bit harder from a quantum standpoint, etc. But no major changes, no major drama expected in my mind on the rate side. On connected lending, see, there's always been this rule which says that directors in banks, etc., if they are themselves trying to borrow from the same bank or from other banks, or if a bank is trying to lend to another company or to another financial institution, and there are some directors in common or director relatives in common, then RBI has always had a rule which says that you need to have a higher level of diligence. And any lending above 25 lakh goes to the board. What this has tended to do in the last few years is that it has clogged the board a lot. Every bank board meeting, essentially, there are lots and lots of cases which are related to connected lending because every institution ends up having some relationship or the other with the bank through some related directors or their relatives. My guess is that there is some rationalization that is going to be brought in there. The breadth might increase, i.e. kind of better definition of what connected actually means. But also the thresholds might potentially be raised from 25 lakhs to something a little bit larger to reduce the burden on boards for them to be able to actually focus on the most important decisions.
And, Jairam, also on the risk weights, that RBI had announced earlier for unsecured personal loans, what has happened since the announcement? We've had some lenders like Paytm say they're scaling down on the sub 50,000 category. But overall in the system, are you seeing the impact of it already start to play out?
Oh, yes, absolutely. I think the impact is very much there. It started with almost a week or 10 days where everybody felt like, oh, there might not be a lot of impact or and so on, but you can see the impact. You mentioned one, the fintech world has been the one that has actually seen the impact most clearly. You saw one of the listed fintech players make some announcements a couple of days ago, and the market reacted the way it did. So clearly that shows that growth is slowing in that part of the population. You saw another fintech company fold up over the last few days. And you will see more in that cohort trying to raise money, strengthen their balance sheets, etc., just to make sure that things remain sane. Credit availability from the banks, NBFCs, other lending institutions for really small ticket lending has reduced already and will continue to reduce. And that was clearly the objective of the risk weights. And though it didn't specify very small ticket thing, but that's where the impact is actually being seen. Anything less than 50,000 rupees, consumer unsecured, supply has come down quite materially in the last 3 weeks.
Okay. Well, Jairam, thanks for that, and thanks, Ritu. I must have missed a couple of questions because we were still with the governor. The big takeaway for me really was the governor not only saying 7%, but DG Patra going on to say that by arithmetic and the November-October numbers, even 7% is conservative. Can I get the Economist view on that, Pranjul?
Yes, Alata, we discussed that. My sense is, I think this delta has come from rural, which has really turned the corner in the last couple of months. At a time you would least expect it to, because it's an El Nino year, but it has. I think many reasons. One is that food prices have been tending higher than MSPs. Second, construction sector is doing very well. So another form of employment is very strong. And third, there's been a huge amount of urban remittances going to rural India, because urban informal sector has also picked up. So I think all of this has made for growth being much stronger and better distributed. And I think once you have this kind of a momentum, it's hard to break it unless a big shock happens. So I think on the back of that, I won't grudge these strong numbers that we are talking about.
No, Pranjul, my question is actually what impact has it had on you, what he said? Has it made you go to 7%?
Well, I was thinking about those numbers, in recent weeks, especially given, all the data that we are tracking for the informal sector and the rural economy. So I'm not really surprised. The part that surprises me is how can you keep inflation so unchanged at a time when you're really talking about runaway growth? Yes. I think that's the part that is a little bothersome.
Yeah, I agree with you that one would normally think fiery growth will mean a fear that inflation will go up. This is one of those unusual cases where growth has been upgraded considerably without, tweaking the inflation number. And that means the governor is backing Goldilocks, and how? I mean, if I were a stock market investor or even a trader, I would take that very positively or very bullishly. Soumya, you were already in at 7%. Looks like the RBI is following suit. Would you want to even up your number more or up your FY25 number? General reaction to the governor's macro statements.
No, I think, Lata, when we had made the 7% forecast, we already had an implicit assumptions. I think we had mentioned also that the growth could have a significant upside of around 20 basis points or so. So from that point of view, I think 7% what the RBI said is actually mostly on the conservative side, given that the leading indicators which we are tracking in the last quarter, October, November, whatever numbers have still come in, are even better than what we are expecting. So expect an upward tick to the 7% number. And my small point over here is regarding the inflation. I think inflation forecasting by the Reserve Bank, I think, has been most accurate, because they have already upended the forecast from some time back to 5.4%, and with a core which is trending sub 4.5. I think it would, to upend the inflation forecast would have been possibly sent a wrong signal to the market. And the governor clearly said that there could be some negative surprises, for example, November and December, but they have to look through the cycle. So what is important is to look through the cycle rather than looking into specific month numbers, which could look a little bit worse off than current numbers.
Okay. Got that. Neeraj, I wanted to ask you what you made of the statements. It looked like there was nothing much for the bond markets and status quoist, but you tell me what were your key takeaways.
So my key takeaway, number one, OMO is not off the table. It is on the table, even though it has always been a part of RBI's sort of quiver, as you mentioned. But when and how it will be used will depend upon the evolving liquidity situation. And possibly, if the government ends up spending a lot of money and hence there is excessive liquidity in the system and that liquidity is expected to stay, that's the time probably OMOs will be used. And I think in that sense, there is a bit of a relief for bond market to say that it is not a de facto instrument that will get used. Secondly, I think the inflation focus continues, as I mentioned earlier. There is no reason as yet to take the foot off the brake, considering the fact that there is upward revision to GDP forecast. The inflation projection is still well above 4%, not expected to reach 4% even by the end of FY25. So I do expect the policy to stay on extended hold. Unless and until there is a big shock which then changes, some of these assumptions. So net, it's a very sort of on the expected lines policy, and I think the bond market will be very, very range bound at least for some time.
Okay, Mr. Ashhish, Vaidya, would you also hold a similar view?
Yes, absolutely. Status quo and quite a similar view. But I just want to point out one caveat. With the supply overhang, which is on the debt side, which is going to happen across the world. We are seeing the noise of that coming from the US as well and other developed markets, including now everywhere across the world. I think one will have to really keep a watch on that. Today's the coverage, the coverage on the 30-year JPY results which were announced is an indicator that somehow the demand on the fixed income longer end also can be waning. So one needs to just keep a watch of those things and then probably interpret as to how things will move. But overall on the India macro as well as how the overall world is stacking up, I'm quite positive. I think we probably look at some sort of a global recessionary stuff, which I told you earlier, coming through by the end of first half of 2024. And then I think we should have a positive rally in the rates environment.
Okay, Pranjul, I want to come back to what the governor said about, 5 consecutive quarters of a pause is, it would be wrong to deduce that to mean that, there is an indication of a shift towards neutral and that a rate sort of cut is completely off the table for now. While, many weren't really expecting that, given the current, sort of guidance that the governor has given on inflation, the risk warning on food inflation, you think this pause is going to be longer than what was initially factored in?
Look, I see this policy as a placeholder policy. The world is shifting in a big way. 2023, most of the world was hiking rates. In 2024, it's possible, according to forecasts, that much of the world will be cutting rates. So we're in a crossroads at this point, and I see this very much as a placeholder policies until the new world order settles down. At this point, some good things have happened. For instance, USD has weakened, USD rates have fallen, oil prices have fallen. But at the same time, domestically, a lot of things are still to be completed. For instance, we still have a long way to go to 4%. Some of our transmission is still pending. A lot of people are not sure if dollar will continue to weaken. What if it's more a sideways stories? What if it strengthens? There's so many moving parts. So I think at this point, the RBI has basically kept all options open. It definitely sounded more balanced than it was in the last policy meeting. But remember, last policy meeting was a time when the USD 10-year had really gone up. The dollar was strengthening. So there's a lot of relaxation there, but it can't become outright dovish because there's still so much to do. So my sense is at this point, this stance, in a way, this was expected. And that's why I think bond yields have been mostly flat. But I think this is a stance which is definitely going to continue over the next couple of months till a new world order, is sort of more clear. And then we can think about, whether rate cuts are needed or not needed. My own sense there is that you can't have everything in world. If growth is going to be very, very strong, then it may not be possible to cut the repo rate too much. So I have very limited easing in the middle of 2024, but that's still many months away.
Okay, got that. Thank you very much, Pranjul, Ashhish, Neeraj, Jairam. Okay, Jairam, I'm sorry. I wanted to ask you just one thing. No added negatives, right? It's the connected lending is more about borrowers who may have a control over the lender. It's got nothing to do with NBFC at all, or unsecured lending. So do you think now whatever cost of money has gone up, that's it? Nothing worse for NBFCs?
That's certainly what it sounds like, and that's certainly the clarification that the governor gave. You know, Lata, in many ways, as I was watching the policy and commentary, it felt as it has in the last few times. It felt a little bit like watching Amol Palekar movies, right? It's not a whole lot happens. It's all nice and kind of good music, good fun. But really everybody comes out happy. It is kind of like that. You can look for drama here, but there really wasn't anything dramatic. It was steady as she goes, and the rate environment for consumers as well as for lenders is going to continue to remain stable. And the key areas from a supply of credit perspective that RBI has spoken about in terms of unsecured lending, etc., will continue to remain under a little bit of pressure, which is exactly the way they want it. So, very steady, Pranjul used the word placeholder policy, very similar thoughts.
Okay. Well, we'll leave it at that. Actually, I guess it's been a very straightforward policy, one without any shocks in terms of extra liquidity constraints. I think the surprise or the positive surprise element has been a Reserve Bank which is almost ultra bullish on growth. It is backing Goldilocks, and how, as Pranjul pointed out, upping the growth forecast without, upping the ante on inflation. They've kept it. They've always been saying that they're going to be disinflationary in their policy till the inflation trajectory aligns towards their target of 4%. It's a copy-paste of that statement. So they're clearly not seeing this, gangbuster growth as creating inflation, as inflationary in any way, which is very, very positive from a stock market point of view. I thought I would be greeted with the 21,000 number continually. Well, I guess the market has other things on its mind. Non-farm payrolls coming up next week, Fed meeting, and as Ashhish pointed out, what's happening in Japan with the demand for the longer-term bonds. So yes, market has other things on its mind, but its worry is not on growth. India's growth is gangbusters, and the most reliable force in the country is backing it, and how. That's for me the most positive takeaway, or the most important takeaway from the monetary policy. From me and Ritu, thank you very much for watching this special monetary policy edition from CNBC-TV18. It's time for a break, and Business Lunch will take the action forward.